Hello, everyone. Welcome to the Selling My Business podcast. This is your host, August. Today, my guest is Jim Beno. Jim is a seasoned M&A advisor who has won multiple awards within the business broker community and has been seen in Forbes magazine, Fortune magazine, and is also featured on Jack Canfield's Hollywood Live show. Jim also co-authored a book with Brian Tracy and other leading world entrepreneurs that made the best sellers list. So, Jim, tell me a little bit more about your background and what made you become a business broker.
Sure, August. Thanks for inviting me to the show. I came out of school, had my accounting degree, got my MBA, and that was in the late 80s. Started to work for Arthur Anderson, actually Anderson Consulting, the consulting side. Worked there a few years and went to as a financial advisor for a local hospital. But I've always had that entrepreneur bug. As a kid, I was always cutting grass, shoveling driveways, raking leaves. And so I started my first business in the 90s, and I've had a few businesses since then. And then on the last business I exited, I sold to a private equity group. And, it kind of at that point was thinking, well, what's next for me? And so I thought business brokering and M&A advisoring was kind of the natural fit because I'm very comfortable looking at tax returns and financial statements and balance sheets with my accounting background. I've worn the hat of the business owner, and I realize all the different hats a business owner makes. I've been on both the sales side and the buy side of businesses personally. So that's kind of how I got into business brokering. That was a little more than 10 years ago. I really enjoy it. It's actually it's very interesting. No two businesses are alike, and when a seller's owner's ready to exit and sell their business, and you can help them get into that next chapter in life, it's very gratifying as well too. So
Yeah.
that's kind of how I rolled into business brokering and M&A advisory.
Awesome. Give us a little bit more details about selling to the private equity, because that's a pretty interesting thing. It seems like PE firms are definitely one of the biggest buying groups for businesses, at least from my understanding over the last 5-10 years. Maybe they've been doing it for longer, but how was that? Did they approach you? Did you approach them? How did that process go? And just curious if you can give us more details on how that went.
Yeah, so I was a distributor of a company, and they were basically buying out the whole company, and then they were buying out the distributors and distributions as well. So it was kind of they approached me on it. So
okay, and then so
it's definitely different than the markets I cover are upper Main Street, lower mid markets, and it's even though you're doing the same thing, it's two different types of transactions as far as how you find buyers, how you solicit for buyers, versus a Main Street business versus an upper mid market business.
Yeah, and what really is that difference in your mind?
Well, think of a Main Street business. The deals that I work with. I'm working with mainly companies doing between $1 million and $30 million in revenue annually. So a Main Street business would be a company, they're probably making, less than $700,000 a year, $800,000 a year annually. And the owner is the owner operator. They're in the day-to-day business, and the buyer is going to be basically buying themselves a nice high-paying job. They're going to step into the owner's shoes, and they're going to be running it day to day, and they don't have any other businesses. This is going to be their 100% focus. They're going to buy the business. That's a lot of the Main Street buyers. Now, when you go up into companies making over $1 million a year in EBITDA, and some of the private equity groups and family offices, they want $2 million. It depends on if it's an add-on or not, or if it's a new platform for them. But typically, they're not going to be running the day-to-day. They'll oversee it. They'll hire somebody. They'll probably ask the seller to stay on for a year or 2 years, or maybe even longer, to help in the transition. And if that business they're purchasing doesn't have a CEO in place, they're going to hire a CEO or somebody to run the business. They're not going to run it themselves. They'll just kind of oversee it. So I think that's the biggest distinction between a business being purchased by a Main Street buyer and some, a private equity group or family office buying it.
Got it. Got it. And so in this process of helping both on the sell side and the buy side, what are some common, I would say, mistakes that you see owners make when either setting themselves up to sell or buyers coming in to buy a business?
I would say one of the biggest mistakes is they just don't have good records or good record keeping. And so what do I mean by that? It's not just your accounting and your certainly you should have some type of accounting software such as QuickBooks or Peachtree, and maybe a point of sale software, depending on the type of business. But it's also records on the business itself, on maybe employee records, as far as having positions on owner manuals on how to do certain types of jobs, so that you have to hire a new owner comes in and buys it, and they have to hire somebody. They know what the strengths they should look for in the hiring process, and also, what to train that person on. Also, HR records. Do they have good HR records? Do they have I-9 files on all their employees? Do all their employees have social security numbers? So when I say records, it's yes, the accounting, and they can look and run reports as far as getting customer concentrations, but it goes deeper than that. It's good records throughout the whole company. So that's a big mistake I see. Another mistake I see is, sellers want to sell at a fair price. They obviously want to get the most they can get for their business, and a lot of times they just way overprice themselves out of the market. I see that. They consult with, maybe another business owner, or maybe their CPA, or maybe their attorney, but somebody who's not in the trenches selling businesses day in and day out. And, the multiples they ask are just ridiculous. And then the business just is stagnant and sits on the market with not much action for a year. And I think by asking too high of a price, it's kind of like the real estate market. Think of it as if houses in your subdivision are selling for, say, $600,000 to $700,000, and you price your house at $1 million, even though houses in that subdivision are going under contract in 30 days, it's going to sit on market for a year. Then even when you drop the price to the $700,000 range where they would have started with, they would have went under contract, buyers get skeptical, saying, "Oh, that house has been on the market for a year. There must be something wrong with it." No, they just priced it too high. So sometimes that can happen with businesses, I think, too.
So what are the biggest? What are the? Oh, sorry, Jim.
No, go ahead. I'm sorry. Go ahead.
I wanted to just, while we stay on that point, I wanted to ask a question. What are the biggest drivers of the business's valuation?
Think of the valuation as the inverse relationship of the risk. So it's the cash flow, or the adjusted EBITDA, or if you're in a Main Street business, we go seller's discretionary earnings, which is basically the adjusted EBITDA plus the owner's salary, one owner's salary. That is times a multiple. So what's that multiple? That multiple is basically the inverse relationship to the risk of the buyer. So what would a buyer consider risky? If the business is trending down year after year, with sales have gone down and net income is going down year after year, that's a lot more risky purchase than if the business is trending up, where the sales and net income has been increasing by 10 to 20% a year for the last 5 years. So customer concentrations. Do you have customers of more than 10% of your annual revenue? So think of it this way: if you had 100 customers and none of those customers made up more than 2% of the business, that's less risky versus if you have 4 customers that make up 70% of your business. You lose one of those customers, your net income could go down drastically. How involved is the owner of the business? That's a big one. Are the customers of the owner or customers of the business? So the more the business owner can make themselves removed from the business, the less riskier it is for a buyer, and the more value you get. So, and a lot of it can be industry too. Certain industries are going to get higher multiples. So typically, software as a service, where there's reoccurring revenues, monthly revenues or yearly revenues. So for instance, my CRM that I use, I pay $600 a year. They could tell me, hey, we're increasing your fees to $1,000 or $1,200. They could double my fees. I might not like it, but I've got thousands and thousands of buyers and sellers in my database. I'm not going to try to switch over to save $600. So I've got stickiness in the customer versus, some businesses, typically retail is going to get a smaller multiple. So it really depends on the business itself too. So does that make sense?
Yeah, definitely. And I just wanted to clarify that because that's like one of the biggest things that I've kind of seen from my point of view with businesses is they think that they are worth a lot more than when you sit down and look at the numbers, what they're actually worth and what the comparables are and, what businesses like theirs actually sell for. So it's kind of a good understanding of trying to figure out,
Yeah, just basically the more risk, the lower the multiple is going to be. The less risk, the more on autopilot the business is, the higher the multiple is going to be, and the more buyers you're going to have attracted to it as well.
Yeah, that's good to know. And then you said there was another point you wanted to bring up with some mistakes.
Yeah, I think another mistake I run across, and I run across this unfortunately a lot, is the owners hold on to the business too long. It's their baby. Maybe they started it 30, 40 years ago, and it's hard for them to let go. And they know they're going to be wanting to slow down. And so, maybe they're golfing or fishing or working 20, 30 hours a week. And, in the past, they were working 40, 50, 60 hours a week and hustling. And so the numbers start trending down, sales and net income. And it's not because the business is bad. It's because the owner's kind of taking their foot off the gas. The problem is most buyers are skeptical. They see the business trending down year after year. They think, oh, the owner wants to sell it because the business is tanking. And so it's hard to sell those type of businesses, number one. And number two, the multiple they're going to get is a lot less. And a lot of times those owners want to sell it based off the numbers they were doing 4 years ago when they were out hustling. And unfortunately, no buyer is going to pay those, that multiple on it.
Yeah.
So those would be the three mistakes I see: bad record keeping, asking prices too high, and owners holding on to their business too long.
Great. One question off that last one that you just mentioned. So from your point of view, when is the best time to sell a business?
Really, the best time to sell is when business is booming, when business is great. All buyers are looking to walk into that business that's where it's gotten double-digit increase in sales year after year and double-digit increase on net income year after year. The challenge is a lot of sellers don't want to let go at that point, but that's the best time to sell is when business is doing well. When business is mediocre or tailing off, it's hard to find buyers for that because they're looking for the business that's growing.
Yeah. Yeah, that's like the hardest time to actually sell businesses when you're excited about how the business is going.
Yeah.
Awesome. Do you have any overall advice to business owners listening outside of mistakes, or do you have any tips or advice that you want to give them just from a general perspective?
If they're thinking about going to market, what they should
They're looking
do?
to sell. They're curious about the whole process. Any just overall advice?
Yeah, I would say number one, make sure, and I know I've hit this again, but I'm going to hit, I hit it in prior, but have good records. Make sure your records are solid, because you may get an offer, but it'll be hard to get it to the finish line if the buyers can't validate, all the financial information. And when you get under what's called due diligence, when there's a accepted letter of intent signed by both parties, there's going to be a whole a ton of information as a seller you're going to have to gather. And so that's why you need good records to verify everything. And so have good records. I would say the other thing is if you're getting ready to sell, make sure you have key management in place or key employees in place, and make the business less dependent upon yourself. Buyers are going to be concerned of, are these customers of you, Mr. Owner, or are they customers of your business? So the less involved you are with the day-to-day operations, the easier it's going to make it to sell and the higher multiple you're going to get. And then lastly, I guess if you're looking to sell, make sure you have a good exit team around you. So who's on your exit team? You're certainly going to work with your CPA. Your CPA knows your cost basis because it's not about what you can sell your business for. It's about how much money you get to keep after you pay all your taxes and the business. And so your CPA is going to be will help on that as far as business structure. You're certainly going to need a good M&A attorney, an attorney that's used to doing purchase agreements and business transactions. You do not want a family friend who is a divorce attorney. No offense to divorce attorneys, but if you're not used to doing M&A transaction and working with the reps and warranty section, you're certainly going to need a good attorney. And then lastly, and I don't just say this because I'm an M&A advisor, but you really should consider hiring an M&A advisor, business broker, to help you with the sale process. Just like if you get sued, you're not going to represent yourself. When you do your taxes, you don't, uh, do your own, taxes most of the time, unless you have a finance background or accounting background. Likewise, you're selling your business. Your focus should be on keeping that business, those numbers up. The most important numbers are what we call trailing 12 months. And a lot of times, if you're trying to do too many things and you don't have a broker involved, your sales are going to slip because you're involved with all the day-to-day transactions. To give you an idea, August, I'm probably 100 hours into a listing before I even go to market, looking at tax returns, financials, writing a marketing booklet. I'm probably 300 to 400 hours into a listing every year, or the first year, whether it sells or not. And most business owners don't have the time or the knowledge to bring it to a successful transaction.
Yeah, wow, that's crazy. So give us an idea, where's your office located? What types of business sizes do you tend to work with revenue wise? I know you said more towards the lower middle market. Give us an idea, if I'm a business owner and I'm looking to sell, maybe I'm in your area and I should reach out to you. Where are you located, and how can they reach you?
I am in Naperville, Illinois. I'm Chicagoland area, suburb of Chicago. My office is in Naperville, and the types of businesses I work with. I'm a generalist, basically. I'm industry agnostic. I work with a lot of manufacturing companies. I love business services, wholesale companies and wholesale distributors, construction companies. I mean, I've sold multiple types of different businesses. I typically do not represent gas stations or liquor stores or anything really. If it's a cash basis, I try to stay away from. It's not my area of expertise. And then size wise, usually businesses between $1 million and 30 million in annual revenue. I would say most of the businesses I deal with are upper Main Street, the owner operator type businesses. And then I have some even the lower mid market deals I've done. Like I've had businesses where there's one that was doing 4.5 million in net income, but it was still very dependent upon that seller. That seller was a very key piece to that business. So, market geographically, obviously Chicagoland area, but really Midwest. I mean, I've sold businesses pretty much all over the Midwest and even the Carolinas. Would I'd say be my market.
Awesome. Cool. And then just real fast, they can reach you by, visiting your website, or how can they get in touch with you if they're in that market?
Sure. I would say the best way to reach me is I'll give you my direct number. My cell is 630-890-5072. That's 630-890-5072. Or go to the website, businessbrokerexpertsinc.com. And my email is Jim Beno, JIMBENO, at businessbrokerexpertsinc.com. So any of those ways. One thing I would say is that, if you're thinking about selling, and I've done this with a lot of clients, have a consultation with the broker. I offer free consultations. Most business brokers and M&A advisors will give you a free consultation. I don't charge any type of listing fee or advertising fee. Sometimes I'm probably too blunt when it comes to listing the business and given a range of where it's priced. But like I said, I don't want to spend thousands of dollars and hundreds of hours of my time if I don't, if the asking price is unrealistic or there's something that I think is going to make it hard to sell the business. But most brokers will kind of sit down with you and get to know the business and say, okay, these are things that these are things that are going to make a buyer nervous. And so if you're not thinking about selling for another year or two, it's a good idea to talk with a broker. I've sold, multiple businesses where I didn't get a listing for 1, 2, 3. One was 6 years after I had my initial conversation because they just weren't ready to sell, but they were able to get the business in shape so that when I did bring it to market, it made it easier to sell and we got a much higher price than had they brought it to the market, when I first talked with them. So
awesome. Well, great stuff, Jim. We really appreciate you coming on the podcast, taking time out of your busy day to do this. And thank you, everyone that's listened to this whole thing. We appreciate you tuning in. And if you guys need any help, reach out to Jim. He's here to help. And or you can reach out to us. We can connect you with a broker in your local market. So thank you, Jim. And
okay.
Until next time.
All right. Thanks, August.
Thanks. Yep. All right. Let me stop the recording.